Hey, everybody. I'm so excited for this episode of In the Money with Amber Kanwar. We've got Ivana Delevska on the show. She's at the forefront of disruptive tech investing. And right now, these tech stocks are getting massively disrupted because of one thing. It's called DeepSeek, and it's out of China. And last night, producer Jillian is here. I messaged you and I said, we got to get DeepSeek in the show.
And I said, yes, absolutely.
And then what'd you do?
Then I had to Google DeepSeek because I didn't know what it was.
For a lot of people, it came out of nowhere and it is costing billions of dollars in market value. Actually, that's not right. It cost the S&P 500 $1 trillion in market value. That's how much evaporated because everyone's concerned that this cheaper version of ChatGPT is going to be massively disrupted. In fact, Nvidia is half of those losses. The rest of the market, though, Jillian, is up. And I think that speaks to something that Frances said on the last show. Rotation is the lifeblood of the markets.
Well, she's a smart woman.
Well, we've got another smart woman coming up. Ivana, let's go say hello. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. I'm so excited to introduce Ivana Delevska to you. She is an investor with Spear Invest, the founder and the CIO. And Ivana, you and I have spoken many times about different topics in tech. Now is such an amazing time to have you because there is a big wreck going on in the tech sector.
That's right, Amber. Thanks for having me.
Now, as I said, I've known you for a long time, and you are a tech investor that really specializes on disruption and knowing where the trends are going. And right now, as I said, there's a big market freakout over DeepSeek, which came out of China and could potentially rival the billions that have been poured into AI from ChatGPT. But before I get to all of that, your background is also super interesting because you founded your own company, but you worked through some of the biggest hedge funds on the planet, Citadel, Millennium, Tiger. So how did you get into tech investing? Was that always part of the work that you were doing, those hedge funds? Where did that interest grow from?
Well, Amber, I've spent close to 20 years now on the buy side, working at some of these hedge funds as well as on the sell side. And I've always covered industrials and technology. So really, this is what I cover right now is the intersection of the two. And that's really where we see most of the innovation happening today and a lot of the opportunities as well. So I think there is a lot going on the technology side that is affecting a lot of basic industries today. So we see a lot of opportunities across the board.
What made you decide to go out on your own?
So I've been working for some of these funds for many years, and I started investing my own money personally, which grew to a point where it became its own product. So then I found out about the ETF structure, and I realized, hey, this is actually a really good way to make what I'm doing today available to every investor. So it really came out very organically. The investment process is very similar to what I was doing before. It's a very much deep research, boots on the ground, really diving deep into fundamentals approach, which I'd always been doing. So nothing changed on the process side. It's just that now, given the innovation in the ETF space, it's possible for it to be available for every investor.
So you launched in 2021, is that right?
That's right.
And then 2022 happens, which was one of the ugliest years for the tech sector. How did you ride that out? And, because we're talking at a time where we're seeing a huge sell-off in the tech sector, I think it's really important to put, this is where you earn your fee, right? Is understanding what is truly going on in the market. So how did you ride out, just starting out your own fund, that terrible period for tech stocks?
Well, Amber, we have a very differentiated risk management approach. So what we do is, unlike most people that will either stick with their holdings and take a big downturn, or others that will cut risk during downturns and then miss out on the upturn, what we do is constantly reevaluate our ideas and come up with new ideas that have equal risk, but equal upside potential, but with less risk. So that is what we usually do. If we see something bad going on in the market, we increase our idea velocity. And that way, everything that's in the portfolio is fresh and based on solid fundamentals.
Okay, well, let's talk fundamentals and how much that was either blown to bits or not at all with this new DeepSeek. This is a private Chinese company that's been working on their own AI model. Over the weekend, it shot up to the #1 downloaded app in the US. And what's really sending shockwaves across the US tech sector is the fact that it was developed for allegedly $6 million compared to the billions that have been poured in to AI infrastructure in the United States. And it's using way less computing power. So, Ivana, like I'm sure DeepSeek, it must have been on your radar. Did I get that right? For the layperson, like, what is DeepSeek?
Yeah, so you're spot on, Amber. This is really a very interesting announcement that came out, but I think a lot of it is very misunderstood in the market. So a lot of it built on prior innovation that was not built on $6 million, if that makes sense. So it's really not the right way to think about it. Yes, sure, you can take $6 million and come up with a similar model to this. However, the next model, it's not going to be, at least the one that is going to come from OpenAI, it's not going to be $6 million. It's going to be based on a lot more compute. And the expectation is that it's going to be significantly better. So I think that's the key thing that people misunderstand. And then the other point I would make is that I think people kind of assume that we're there and we've invented everything there is to know or do with AI. And now we have these great models. It's really not like that at all. These models are still in the very early innings. So today, really, like the first ChatGPT model that we saw, really all that it was able to do is generate information based on what's out there on the internet, right? So that's great. It's still very valued, but it's not really gonna end up in real, like you can't really use it to train a robot to go out on the streets, right? So now these newer models like O1, they're more iterative, but they're still really like far from where we need to be in order to have like robots walking around. So there is a long way to go from here, from O1, O3. I think it's going to be a big disruption. There's really a long way to go before we can really see the true potential of AI.
So you don't think that the fact that they were able to do it at a lower cost is a game changer? For example, Nvidia, and I know we'll talk stocks later, but it's imploding right now because the concern is if I can do this for $6 million, and I hear you that you don't think that's the real price tag, but it's a big gap, even if it was a little higher compared to the hundreds of billions that they're expected to rake in from that, it kind of seems like it is a big dent in the thesis that NVIDIA is just going to rake in all this cash from their very expensive chips when you might not really need them for the innovation.
Well, that is where the market is wrong, right? I think China does not have access to the big chips. And the reason why they've been able to be successful is that they've found ways to improve the software and go around some of the issues. That is not to say that the big chips are not useful. So now if you can marry software innovation with the big chips, then you're going to see like what's really possible. So I don't think this puts a dent in the NVIDIA thesis at all. If anything, it makes the thesis stronger. So the way I would think about it is that this is just another very solid model. We've done some research on it to understand the drawbacks and positives. It's a very good model, done cheaply, great, but this is not ultimately where we need to be. So I think this just reinforces the thesis that there needs to be more innovation done here, and there's going to be even bigger need for NVIDIA chips, in our opinion.
So this didn't change your conviction on the sector, the trajectory of AI?
Absolutely not. The only thing that this is negative for is the other model competitors. So if you're building models, this is a new entrant for you, right? So these are companies like OpenAI, Anthropic. There is fierce competition there because everybody has access to the same hardware, and the Chinese don't even have the same level of hardware, and they're able to come up with equally good models. So it's really going to be a race here of who is going to come up with the next big model. A lot of it is going to come from the hardware advantage that the US players have, but we'll see some features used from these Chinese models as well. So it's really more innovation, if you will, on the models side. It does affect the competitive dynamics on that space. But in terms of power gen, networking, chips, I don't think it changes any of that. We still need to see significant improvement from where we are today.
You also have to include geopolitics in this conversation, right? There's basically a de facto Cold War between the US and China. So even if China was able to innovate, I wonder how much US companies are even going to be able to take advantage of that technology. I mean, they just banned TikTok. You think that they're going to allow this AI infrastructure to permeate everything when there's clearly an arms race going on?
Yeah, absolutely. Some of these things are actually public in terms of how the model was trained. So it's not necessarily that companies are hiding it. So you can easily use, like US companies will use whatever the Chinese are doing and vice versa. So there's really no way for people to hide how they train these models because people can back into it. And a lot of the papers are published publicly. So they're called open source models. So this is why I think open source models are really winning, where you're really disclosing what you're doing. And yeah, so basically this is why DeepSeek is a big deal.
And OpenAI is closed
Yes.
source, right? And so that's kind of, I guess, highlights the difference.
Versus like Meta is open.
Is open as well.
Mhm.
Okay, so this highlights the difference in that. I guess the question is, and again, we're going to talk stocks and your highest conviction ideas, but in a general sense, you're looking at some of these names down between 15 and 20%. What do? Do you hold strong? Are you buying the dips? Is it irresponsible to buy the dips because you don't really know where the conviction is?
Well, no, for us, it's not irresponsible to buy the dips at all because we have pretty strong conviction. I think what's happened in the AI space is a lot of people are chasing the same trades without having done proper work. So that's really where our differentiation comes, where things like this happen. We kind of know whether NVIDIA chips are needed or not. And we know where the innovation on the performance side will come from, as in networking. So we are pretty well in tune with what developments are coming. And we think we're just in the early innings of this model development. You're going to see much better and better models coming out of it. So we have pretty high conviction for us. This changes absolutely nothing. And we're looking for dislocations of where you can take opportunity.
I mean, we're seeing a big one, certainly this week.
Yeah, exactly. So this is like exactly what we want to see.
Does this maybe tell you that there's lack of conviction out there, or people's conviction is starting to wane? Like, how prepared should investors be? Because tech has just been such a runaway home run for so many investors. Is this the year you got to buckle up? And maybe there's several times that the NASDAQ pulls back 10% or more.
For us, there is a price where like, okay, this is a good entry point where we can generate 20 plus returns on a compounded basis, or this is a point where like it's getting harder to justify buying a stock. So for us, it's really like we have a very simple framework that works, and this type of pullbacks are an opportunity. Now, if we were invested, let's say OpenAI or Anthropic was a public company and we were invested in it, we would be out.
You would be out. So you think this is a big problem for OpenAI, for example, has raised $18 billion at $157 billion valuation. What do you think it's worth now post DeepSeek?
Well, we're going to see, right? Because this just makes it so much harder and harder for the model companies. And it's going to make it harder for them to continue to raise money, right? Because as soon as investors see the competition, it is going to be much more competitive than other spaces. And especially with having like Llama being an open source competitor, it's really that space is getting a little tight right now, and a lot of funding is being poured, and the fundamentals are pretty tricky. So yeah, like I think that's basically, if I were to explain to people how do we think about things, is if something were to happen where we think like, hey, we actually don't need NVIDIA chips, yes, we would be out of NVIDIA, but this is not the case at all. In fact, if the Chinese could get access to these chips, they would get them yesterday.
So I found it pretty interesting. And you said that OpenAI maybe is vulnerable here. Microsoft, which of course has a big position in OpenAI, the CEO tweeting, and I had to research what this was, Jevons paradox. Do you know what this is? Where in the long term, an increase in efficiency in resource in resource use will generate an increase in resource consumption rather than a decrease. So right now, everybody's afraid, oh my God, they've done this for so much cheaper and, it works better. What does this mean for demand? Jevons paradox will say, yes, it's so cheap that now consumption is actually going to overall increase. And I thought it was interesting that you have a CEO who's definitely got some skin in the game, really trying to say, actually, this is still good for the sector. Do you agree?
100%. And this is really, if you look at Jensen's comments as well, they're along the same line. So he's saying that compute power is expected to increase 1,000 to 1,000,000 times. So that kind of tells you, and basically when that happens, that's when you can do real useful applications. So we're really a long way to go. And the idea is that any sort of innovation that happens is a good way to broaden out the market to encourage new applications. So what you're going to see with these iterative models, this is exactly what we need today, right? Where the models of the past, they were done in a way where the model is trained and then you're continuously inferring from that model. The model of the future is going to be continuously trained. So you're going to be doing inference and training at the same time. These are basically the first 2-3 versions of those type of models. And we expect we're going to get to like version 100 within like years time, right? So that is spot on. That is how to think about these innovations. Whenever something happens, it just broadens the market rather than shrinks it to like, oh no, like this one company is going to win.
I mean, I could make this whole show about DeepSeek, but we actually got a bunch of other questions about different stocks. And to our audience, you're going to want to stick around for the pro picks because they definitely have succumbed to these DeepSeek fears. And so Ivana is recommending you buy the dips on some names. Which names? You'll have to stay tuned to find out. But let's dip into our mailbag for some viewer questions. Our first question, Ivana, is about Tesla. This one coming from Bill. Tesla is up more than 120% over the year, thanks in large part to Elon Musk's relationship with Donald Trump. Is it time to sell or should I keep holding? I mean, you're such a fundamental analyst, right? You've said this so many times, and I wonder how you think about like a friendship helping a stock.
Well, that friendship is more than just a friendship, right? So just to give some background here, if you look at Tesla, they have 3 components to the story. One is the EV side, which I think has gotten very crowded, right? So if that was the only component of the company, I think it would be very hard to justify the valuation as an auto EV manufacturer. Then you have the other component, which is FSD.
Yeah, fully self-driving cars.
Exactly. That is autonomous driving, but as a feature, not as a robot, right? So that's the big difference. So even if you look at the autonomous driving as a feature, you would probably get to a price point close to where the stock is trading today in the 400s. Now, if you want to justify upside, it's all about the robotaxi opportunity. And this is where Elon Musk's friendship with Trump comes in, right? Because for the robotaxi, there are 2 main things. First is the technology, and second is regulation. If you do the math where like robotaxis are replacing drivers, that's where the real value comes in. So any sort of thing that gets you closer to it, whether it's on the technology side or on the regulatory side, really helps justify the upside in the stock.
Upside to where? Where do you think Tesla should trade?
Well, you can think of it this way. How much would it be worth if Tesla was generating $200 to $300 billion from robotaxis? And remember, this is actually a very high margin opportunity. So we don't have published price targets, but you can easily see the stock compounding at a 20+% rate if this was actually to materialize.
Okay, so here's a question. Why wouldn't you just go to Google for that? Because they already have robo-taxis that are in market, and you look at how Google's trading, plus they've got a whole bunch of other AI stuff, and they don't have an EV business that is, potentially a drag here. It's a lower multiple, and they're already in the market that you're so enthusiastic about.
Well, Waymo is a very different product offering, right? So first of all, it uses a lot more sensors. So it's a lot more expensive product. So to bring that product to a mass market is going to be a lot more difficult. So that's number one. So even if you see the vehicle today and you're like, hey, this looks like it's driving pretty well, the question is, can this vehicle be economical for production. So that's number one. Number two is that Waymo's strategy is to map city by city. And that's really the big bottleneck to scaling. Tesla's platform is a lot more scalable today than Waymo's platform. And this is why Tesla is talking about maybe doing this for other automakers, right? So that can just broaden the installed base of vehicles. So say like if they were to partner with Ford, because Ford is clearly not going to be doing this in-house, right? They're going to need a partner. Tesla can really capitalize on that opportunity. So over the next 2 to 3 years, we think most companies are going to have to pick which autonomous strategy they're going to pursue. And really the two dominant ones that we see are Tesla and Nvidia. So really, Nvidia is even better positioned than Waymo from a platform perspective than just a vehicle that drives by itself.
So we actually got a separate question on Google as a standalone. So I hear you on a relative basis. It sounds like you prefer Tesla to Google. What about Google just as a standalone? This one coming from Nathan in Toronto. Do you like it?
Google looks okay on a standalone basis. We owned it for a short period of time last year on the quantum computing opportunity, and that got priced in very quickly after the announcement. It looks okay. The fundamental business of advertising is a little bit under fire. So you're really going to need some of these initiatives to scale to cover up for that. So there's just a bit more risk associated with the story, which is why we don't own it today.
Another question is coming about Palantir, and I love how direct it is. Do you like Palantir AI technology? Why is it so hated? And I don't think I've ever seen an AI stock with this many cells surrounding it. 7 cells, which is high for any stock, let alone a stock that is supposed to have AI around it. 13 hold, and only 4 buys on a stock that has done exceptionally well over the past year. I mean, it's up 360% over the past year. Can you explain, what is the Palantir story?
Well, very interesting, Amber. And really the reason why fundamental analysts don't like it is exactly because it's up 350% year to date, right? So if you look at any sort of valuation metric, whether you do a DCF model that models it out 30 years, or you look at a multiple relative to its growth, Palantir screens very expensive. They have a very solid business model where they help companies organize their data. And then on top of it, they can use AI applications. But the real value add is that they kind of like can be almost like your outsourced ERP system. So if you haven't done an ERP integration and your data is all over the place, they can really get you organize it before you can run anything. So that's really where their edge comes from.
They do a lot of government work too, right?
That's right.
Is that big? Is that helpful? Like, how should we think about that?
Well, the government work is very important, but it's a little more stable and lower growth. The big opportunity is on the company side, right? On corporate side. So we really want to see more companies adopt their solution, and there are pluses and minuses to it. So the plus of it is that you really don't need to do anything. You can just hire Palantir, they organize your data. The bad part about it is that they are in charge of your data. So if they're like go somewhere, you have no data. So the alternatives to it is platforms like Snowflake or Databricks, where you're in charge of your data and you're using these as a tool to work with your data. So we think those are more scalable than the Palantir model, where they actually have to like onboard customers and have their data.
So if you're a company looking for like a plug and play AI solution, you think Snowflake and Databricks would be A, better business, B, better stocks than Palantir?
Yeah, if you have a tech team that can already do some work on their own, Snowflake and Databricks work a lot better. If you don't want to do any of your own work, Palantir is a great choice. If you're a company that has some sort of a department and they want to do technology, Snowflake is the best choice. And if you're like tech forward and this is like your business proposition, then Databricks is the one to go with. So that they really all have their own niches where they are really well positioned. And there's obviously some overlap across the board, but that's kind of how we see the landscape.
And considering the big sell-off in AI-related names, Palantir is holding up relatively well. It's only down about 4%.
So yeah, today we're really seeing the hardware part really get hit hard. Everything in software is doing significantly better.
Well, certainly not if you are part of the AI infrastructure. You're not doing well. And that's part of our next question. This one coming from Susan, and it's about GE Vernova. GE Vernova is supposed to be part of the solution when it comes to all the power that is needed for AI, but it's down on the DeepSeek news. Is this a buying opportunity on GE Vernova in particular? And I think, has it been a top 10 holding for you? Is it still?
Yeah, absolutely. So I do think this is a great entry point for anything energy and hardware related, because clearly the news has nothing to do with us using less hardware infrastructure. And to step back, what's particularly attractive about GE Vernova and the electricity names is that we've already gone through a pretty significant down cycle for energy over the past 20 years. So gas equipment has been dead basically for 20 years. So now with the excitement around data centers, that's getting reignited. But even without data centers, this would have been a pretty attractive market growing from the bottom. So I think it's not only about AI, even though today it does look like it is. If you look at the fundamentals, gas will do well no matter whether we have 5 new models getting introduced or not, just because of electricity demand increasing.
So you like the GE Vernova story, even outside of the AI torque?
Absolutely.
All right. And you're an industrials expert, so that's kind of where that name traffics in your expertise. This one is kind of a throwback. Remember, we were all obsessed with quantum computing because those stocks had run away before DeepSeek kind of splashed into the foray. But these quantum names have been so volatile. You've got sharp, sharp moves to the upside, really severe pullbacks. One of the catalysts for the pullback was because of Nvidia's CEO, Jensen Huang, basically saying he doesn't think quantum computing is around the corner. It's probably 20 years away. This question is coming from Bruno. Do you really think that it's that far? And because you focus on disruptive tech, are these names that are in your portfolio right now?
Well, that's a great question. And I think Jensen's comments were taken a little bit out of context and completely amplified. So I think it was super interesting that most people involved in the quantum computing industry know that quantum computing is years away. And that's really not the point of debate. So we like quantum computing. And now with the innovation in hardware, we're able to use different models to error correct, which is a big problem that quantum computing has been facing. So this is happening today. It's not happening in 50 years, even 15 years. We're correcting errors today. And that was the big Google announcement. But the same CUDA Q, which is an NVIDIA product, architecture can be used to improve other quantum computing products, right? So I think there is a lot of innovation going on in the quantum computing space. So that's where you want to be investing today and not in 15 years. The ultimate applications that will change the world using quantum computing, those are 15 years away. But that's not where you want to, when you want to invest, if that makes sense.
Do you have a preferred name in quantum you like?
So there is a range of names. Google is the lowest risk name you can invest in. We're not invested in it, but that would be like the lowest risk way to get exposure. IonQ is in the middle of the pack because they are generating revenues today and they're on track to reach $1 billion by 2030, and they've done a decent job executing. And remember, if you look at how NVIDIA scaled their hardware business, I think a lot of people think that NVIDIA showed up in 2023 when ChatGPT got announced. But that's not true. They've been scaling this business for exactly 15 years. So that same path we accept will follow by IonQ, where by 2030, maybe they're at $1 billion and then they start being profitable. And that's when you get some sort of a lower risk and the stock will be less volatile.
Okay, IonQ in New York, IONQ, and you're going to give me a third one?
Yep, and then Rigetti is the third one, which is the highest risk. They're based on a completely different technology, which is seeing the most improvement today. So it's similar to Google in terms of technology, but it's open source. And if you're a customer, you can use them as part of AWS. So if you're an AWS customer and you want access to this, you can access both Rigetti and IonQ's model, which is really a big deal because this allows them to scale once there are more commercial applications.
Rigetti, RGTI in the US. We're going to just ask one more question from the mailbag. This one's about a Canadian company, Shopify. You've said Shopify was a big winner for you. Do you still hold the stock? Would you buy it now? This one coming from Joe in Niagara Falls.
So we still hold Shopify. We still like it a lot. It's a little bit of a smaller position just because the risk reward is a lot lower than where it was, say, 2 to 3 years ago, where it was an outsized opportunity. I think Shopify is a little misunderstood in terms of how they're positioned, especially as an AI play and how they're positioned to lever AI.
Are they an AI play? How are they an AI play?
Because basically, Amber, the way this is going to work is, speaking of robots, there are 3 buckets. One is agentic AI, one is humanoid robots, and there is autonomous vehicles. Shopify will benefit in the agentic AI bucket.
What is that? What is that?
That is basically agents that work on your computer and help you do your job better. So right now, there's an early version of them, which are the co-pilots, but they don't work very well, right? So if I tell my co-pilot, hey, give me a list of my biggest 20 customers, it's not going to know what to do, right? The idea is that in 5 years, the technology is really there. It should easily search through my CRM system and tell me, hey, these are the 20 people you should be talking. This is who's been interested in your product. And Shopify will be very similar like that you can use their AI agents to help you. What are people interested in? Manage your inventory. How should you be doing things? So literally all of these companies that have large installed bases, like Shopify, CRM systems, they're going to be able to use these agents to enhance their business. So that's really how it's an AI play.
All right, let's get to Ivana's pro picks, her 3 best investing ideas. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Ivana, these are the 3 best ideas that you've brought to us, and we should say that each of them today are having a terrible day in the markets, and maybe that's part of where the opportunity is. And of course, they are flinching from DeepSeek, which was announced out of China, allegedly a cheaper, better AI model that is out there. And so it's claimed a lot of victims in the market when this, shot up to number 1 in the App Store. The first victim, and one of your top ideas, is Constellation Energy. And again, the AI story has been about these semiconductor companies, but it's also been about all the power that's going to be needed to power these high-intensity data centers. So that's maybe why Constellation ran up. Now we're seeing such a sharp pullback. And the question, Ivana, is what do you do?
Well, I think this is a great buying opportunity for Constellation. With this pullback, basically, you're getting it at a point where there is pretty significant valuation support. And just to give some background here, Constellation is the largest nuclear power operator in the US, holding the largest portfolio of nuclear assets. So anywhere you look at it, whether it's under the prior administration or this administration, nuclear is really well positioned from reliability perspective. So I think that even if data center demand, like in our downside scenario models, even if data center demand surprises to the downside, we still see energy being very tight or power generation being very tight in the US. And nuclear is basically the best way to plug the hole because they're really both reliable and clean.
That's a really interesting point. I want to underline it because you said that kind of with GE Vernova as well. You think these class of stocks can do well even without tremendous AI demand? I mean, I thought that's why these stocks were running up so much.
That's 100% why they're running up, Amber. But what ends up happening is that people, when they invest, they don't necessarily do the work. So they jump in on the trend. And then when something like this happens, they need to jump out because they don't quite have a fundamental framework and where is a floor and where is an upside case. So that's really where we come in with our research, because to us, it's pretty clear what the opportunity set for Constellation is this year. We have several catalysts coming, like co-location deals in the US that will be announced, that we're pretty confident are going to be announced over the next 6 months. So really, for us, this announcement changes absolutely nothing on the fundamental side. But even in a downside case, we see upside for this stock.
Okay, so that brings us to number 2, which is Nvidia. And I almost feel bad we buried it at the end of the show because that's all people want to know. If you own it, you're asking today, should I sell it? And if you didn't own it, you're asking, hey, it fell 17% in a day. Should I buy it? Talk to me about why you'd feel comfortable stepping into Nvidia on such a swift down move.
If you look at Nvidia's valuation, around 20 times is the floor for the stock. So it's been in a range from 20 to 25 and all the way up to 30. Basically, when it gets to 20 is when you want to be buying. When it gets to 25, you can also be buying. If it gets to 30, 40, that's when you want to be questioning whether there is a bubble. And the reason why this is important is because these multiples are on the company's earnings. The upside in Nvidia, in our opinion, will come from them growing the earnings, if that makes sense. So the valuation multiple is going to stay constant here. And if they can grow earnings, people are all of a sudden going to be willing to pay even higher multiple for it.
So much of the story has been, I guess, revenue driven for Nvidia. You know, their sales growth has basically been more than doubling for the last couple of years as everybody wants these chips that they make. It sounds like what you're saying, they're going to start to focus more on profitability as maybe that top line doesn't double anymore. And then you have to look at it. How much are you willing to pay for those earnings? The question, though, is did DeepSeek make the business less attractive, make it less I mean, Blackwell chips are their latest generation chips, right, are between 30,000 and 3 million. I know you're skeptical that DeepSeek was able to build on cheaper chips or to do it for cheaper, but doesn't that put somewhat of a dent in the thesis that everybody's going to want to pay up for these expensive Blackwell chips?
Well, there are two parts to the story. On one hand, I want to clarify that I'm not questioning that DeepSeek was able to train their model for 6 million. They were only able to do it because other models existed prior to that, right? And that's a big clarification. So I don't think they can innovate unless somebody else innovates. And how is somebody else going to innovate? By buying Blackwell. So that's what we think is going to keep happening. So you're going to have companies like OpenAI buy even more chips, innovate, and then you're going to have the Chinese innovate on lower cost architecture, but they really need that innovation that was done on the higher end chips, if that makes sense. So I think there's just going to be a flywheel of innovation that's driving the need for even more hardware rather than less hardware. I don't think this is a case where we are like, oh, turns out we don't need chips anymore. That's basically like saying, hey, we don't need computers anymore. We can just use what we have today or what we had in the past, right? So these are constant innovation themes where you always want to have a better product and a better hardware to run on.
Okay, so you like Nvidia for the valuation. You think the pullback is attractive. Another stock that really took off recently is Marvell, another semiconductor that is in the AI flywheel. First, talk about, and it's also getting run over on this DeepSeek issue, but talk to us first about how Marvell is different. How are their chips different from Nvidia? Why was there such enthusiasm, post their latest quarterly results? And why is now a great buying opportunity?
So Amber, Marvell plays on the custom chip side. So while Nvidia has a chip that works for everybody, the hyperscalers want to come up with chips that they can use internally and maybe come up with some applications that other customers can use. And they need to go to companies like Marvell. So Marvell is a partner with AWS. They're developing their chips. Broadcom is partnered with Meta and Google. Those are Broadcom's biggest customers. So basically, when you're developing an in-house chip, you need to partner with somebody like Marvell, which is why we like it. They're also a leader on the networking side, which is going to be how we're going to see a lot of the hardware improvement going forward. So those are the two areas of the Marvell story that we really like.
And it's pulled back just like the others. You feel comfortable stepping in here? Why?
That's right. So it's very similar to Nvidia, where we like where the valuation stands today. So the upside is not going to come from valuation, it's going to come from earnings, but your floor comes from doing the valuation work correctly. So at a certain point, the stock will not trade below a certain valuation level.
All right, Ivana, thank you so much for joining us. A calm head on a sort of nutty week for tech stocks. I appreciate it. Join us on the next In the Money with Amber Kanwar. We've got Mark Sebastian on the show. He's the founder of Option Pit and chief investment officer at Carmen Line Capital. He talks pretty much all North American large cap stocks, so you can get your questions in now. Email us at questions@inthemoneypod.com. Find us on X, Instagram, Facebook, or TikTok. Or you can submit your questions through www.inthemoneypod.com. We'll catch you in the next episode.